Okay, we're talking about entrepreneurial financing, and we are looking at a spectrum of different resources that entrepreneurs can use to raise financing. Everything from using your full-time job to raising money from an early stage VC. These are in order of sort of complexity and how much the funding source would demand from you in exchange for funding. Specifically today, we're talking about this piece, which is the equity or venture capital piece of the equation. And right now we're going to talk about angel investors. Angel investors are often discussed and often misunderstood by inexperienced or young entrepreneurs. And it's important to understand how they make money, under what circumstances, how they relate to your company, and what they potentially can bring to the table that's positive or negative. So let's talk about what exactly angel investors are. Angel investors right now are typically high net worth individuals who have some interest in investing in small companies or in startups. And they will play both an operational and a financial role sometimes, which we'll talk about in a second. However, we can define angel investors by the fact that they're what's called an accredited investor. And what an accredited investor means is that you have a high net worth, or you're a high net worth individual, and that's defined as either $250,000 a year in income for 2 years in a row, or $1 million in net worth. These rules change sometimes over time, but currently that's how it's defined. Interestingly, an angel investor is not investing someone else's money. It isn't like a venture capitalist who might be investing money given to him by investors of his own. This is their own money. It's their personal assets. Sometimes these come in the form of corporations or investment funds, but really it's their money that's being invested in. That's important because angel investors will have a very strong tie to the company, both financially, emotionally, and otherwise. So this is important that they will often invest alone, especially if it's not that large of an investment, but sometimes they'll invest in groups, and they'll organize themselves into groups. So typically a city or an urban area will have more than one group of angel investors that will invest together side by side in small portions with one another. And that gives them some advantages in terms of having more people thinking about the same investment or participating in the same investment. So in this case, we'll talk about the economics in a second, but angel investors will vary in terms of the size of the deal. Usually you're talking about anywhere from as small as 50,000 to $1 million plus that you could potentially raise from an angel. So these aren't $5 million rounds that you would find in the VC world. They can be small or big. They can be companies that are going to cash flow or companies that they're trying to exit in the classic sense, and we'll talk about that in a second as well. So angel investors really play this role kind of on the spectrum here, where if I've tried all these other things or I need more money than these can provide and I don't want to get a loan or I can't get a loan, this might be my first stop before a seed fund or a VC. You'll also sometimes hear people refer to this as friends and family, which isn't really accurate because friends and family don't invest under the same circumstances. In fact, I put friends and family way back here, but these are accredited in high net worth individuals. So let's talk about the economics and their motives. The angel investors all have different motives, and this is something that is difficult to pin down and sometimes scary about them. Those motives might range from straight up financial returns, that they want to make money, to social status in the environment that they operate. They just like to be involved in things like that. Or even that it's post-retirement and something they're doing to kind of keep themselves working to a limited degree with new companies. So keep that in mind, and that angel investors' motives definitely change over time. And make sure you find out what those motives are from any given group of angel investors. They also tend to be regionally focused. Unlike VCs, they'll concentrate on a region near them where they can participate in and play a role in the companies. And this is also a really broad statement, but expect they'll want between 20% and sometimes over 50% ownership in a company. So they're going to take a big chunk of equity. You're going to sell them equity in your company, and they're going to give you money in exchange for that equity. So this will generally be a fairly big chunk of ownership. Can be smaller, but that's sort of the target range they look for. because over time, often those companies will raise additional money and go through dilution. So in order for an angel investor to have any meaningful ownership, they're going to want a big chunk. Also, young companies in this scenario, when they're raising money from angels, may not be worth much. You won't have a very high valuation. So for a small amount of money that you take in, you're still going to give away a big chunk of the company. So that means that these guys are high-risk investors because they're investing so early. They're often the first, substantive money into a company. So what are the economics of how they typically invest? Like we talked about, they invest very early and they buy equity. Their goal is to grow the company from an operational perspective even until either a Series A or some sort of exit. And that's how they make money. They'll sit on the board of directors. Typically they'll provide advice and they'll often provide operational involvement, meaning they'll really get their hands dirty and help you grow the company. The terms that they demand vary widely. They'll often demand things like preferred stock, or sometimes they'll take common stock. They'll use convertible debt as a financing vehicle sometimes. They will demand reverse vesting of founder shares, and then an options pool and other sort of equity structure agreements because they're a little more sophisticated of an investor. But really important to understand that vary widely. Some angel investors are very savvy and will demand things that are more complex, and some won't. There's also a question in terms of what can go wrong with angel investors that we should talk about that we call moral hazard. So essentially, because the person is so closely aligned to the operational decisions sometimes that angels will play that role, and they're also investing money, that creates kind of a complicated situation. They'll invest money in a company and then they'll have the power to hire and fire people on an operational basis, so they can get sort of economically and ethically confusing and complicated. So there is a moral hazard associated with angel investors that maybe you wouldn't have in a larger institutional setting. So let's talk about how they make money really quickly and what a good outcome or a bad outcome would be. A good outcome for an angel investor is going to involve some sort of exit event or a company sale or a cash flow company. So let's say they invest in a cash flow company like a restaurant that's going to make a profit all the time. If you're cash flowing, you're generating money, you're going to start paying them back in dividends or disbursements. So they're going to make their money back slowly over time. That's one outcome. The other outcome is an exit. So they invest, here's your company ownership at the day the angel investor invests, and the angel investor puts in 100 grand, and the rest of your company is worth 200 grand. So in total, it's worth 300,000, and the angel investor owns 1/3. Over time, we've talked about dilution. The angel investor will get diluted. They may raise a Series A round. So one good outcome would be they go to venture capitalists to raise a Series A, and the venture capitalist just buys them out and buys their shares. That would be one option. Also, their shares might get diluted down so they have a smaller ownership percentage, but the company's worth more and they own common stock. So when you sell the company and you do an M&A, a merger or an acquisition, or you do an IPO, which are exits, types of exits, if the company sells for $100 million to a larger company, and this guy only owns 10%, he'll make $10 million on his original investment of 100 grand. So that would be a great outcome. If you IPO and the company goes public and it has a market value of $100 million, same thing. They own a small percentage and they can sell those shares on the open market. So that's the end game for the angel investors, is that they make an early investment, they own a big chunk of the company. Their chunk might be made smaller over time as they either raise additional funding or experience dilution, and then you're either going to sell the company or you're going to go through an IPO, which is your exit event, and they make money from their selling their shares, their percentage ownership in that exit event. So those are all important things to understand about angels and kind of where they fit on the spectrum of investors.